G'day guys, Ray Corcoran here. So in this week's video, I'm going to be going over, I've dragged my accountant onto things and I'm going to get them to, I'm not an accountant obviously, but I get a lot of people ask me about how to save on tax and that's not my area of expertise. So I've brought my accountant, someone from the accounting firm that I use. We've got my man Riz here today. Riz handles all my crap and my increasingly complex finances, which get more complicated by the week. So basically what we're going to go over today is 12 tips to reduce your tax bill in 2022, and obviously doing it legally. And just the obvious disclaimer, this is not tailored advice for you. If you want to get professional advice, I would definitely recommend doing that before taking any action on your finances and tax situation. If you want to chat to these guys, you can chat to them. I'll put links to their stuff below or around this video. And just to be transparent, I don't get anything, financial benefit out of recommending these guys. They're just simply who I use, and I've been really happy with them. I've been through a bunch of crap accountants, frankly, and for me, a good accountant is worth every single dollar. And having people that also understand the modern business and they understand crypto and a lot of the more modern things, and can do all the classic stuff that an accounting firm would do. For me is very valuable because most of my business is, online and, we've got property and trusts and all sorts of stuff. So they handle it with ease. And Riz, if you just want to say g'day, maybe just give us a bit of a rundown of who you are and a little bit about Inspire.
My name's Riz. I'm one of the associate partners at Inspire. And we're proud to say we've saved over $18 million in tax for our clients since we started counting. So that's still going on. So we're really, really excited about that. So this is the 2022 tax rates. And essentially there's three different entities: the individuals, companies, and trusts. As you can see, the individuals pay quite a bit of tax, all the way up to 47%, including Medicare levy. And then you can see that company tax rates are flat tax rate at 25% or 30% if it's a company that's just holding passive investment. For a trust, depending on the trust deed, typically it doesn't pay any tax on its own because it ends up distributing its profits all the way to the individual beneficiaries or corporate beneficiaries. So they use those two different tax rates. If you don't distribute it, there might be a trustee tax that you have to pay, and that can go up to 47% as well. So that's a little bit of a context, but let's jump into the strategies. So kind of step one is we usually see this done wrong, but the amount of salaries that are paid to business owners can sometimes be quite excessive. It's not rocket science, but we've seen this happen time and time again. The amount of salaries that a business owner takes can be varied year to year, depending on how profitable the business is. I've seen cases where the salary doesn't change and it drives the business into a loss, where the business owner would have paid tax on the profit or on the salary that they took out, whereas the company or the business that they runs into a loss instead. Now, obviously, this is not ideal because it is your business and your profit at the end of the day that you're paying tax on. So there's some unnecessary salaries sometimes, but there's also excessive salaries I've seen.
And that was something you did with me when I first came to you, because I was paying myself a salary that I felt comfortable with and whatever. And then you chatted to me about how much I was actually spending, like what was my living expenses to live, and I was paying myself a lot more than what my living expenses were, and but I was paying too much tax unnecessarily as a result. So we actually brought my normal salary right down, with a little bit of buffer for expenses, but it was that saved a lot of tax just structuring that different.
It kind of works with the second strategy as well, which is to use your family trust correctly. Now, it just depends on what type of business you have and what type of structure, but we like to incorporate family trust somewhere within your business.
And is this for the people that have a 9-to-5 job? Is a family trust? Is it still beneficial if someone had a 9-to-5, or just maybe less beneficial for them versus a business owner? Thoughts on that?
Yeah, absolutely. And I think that there is still a benefit in using a family trust, both from tax planning and asset protection reasons. But definitely a little bit less if you're not running a business. Let's say you have an investment portfolio, or even if you have properties that you want to invest in, a family trust is a great way for you to buy those assets in where it will afford you some level of tax planning for the capital gains and returns from those investments. further to that, there's also a level of asset protection and succession planning that you can include in your family trust as well. As you build this wealth, you want to make sure that it goes to the right people.
Yeah. And if any of this sounds foreign to you, obviously, like for me, this all was foreign to me before I learned about it. So it's just a case of speaking to, whether it's Inspire or speaking to a professional, they'll be able, that's their skill set to help you understand what it does and how it can, help you with your tax situation. So if any of it sounds like gibberish or it sounds really confusing, it kind of is when you really dig into it. But it's not your job to do that. The accountants, that's what they specialize in, and they can sort of help you with that. But we'll just keep it moving to number 3 as well.
Yeah, great. And this kind of ties in with the previous strategy as well. There's a companies are an effective way of managing tax as well when you have a company. So when we tie that in with using a trust, it's a great way for us to park some money aside with a capped amount of tax that we pay for that year. And what I mean by that is, in the instance that we imagine a jug full of water, and that's the profit or the returns on your investment, and it has to be taxed, but it's a trust, and it has to distribute that profit each year. And essentially, what you do is you start pouring into all these cups. Now, if all your cups or family members, which are your cups, are full, what you end up having is some excess profit sitting in the trust. Now, if you leave it in the trust, the trustee might get taxed by that, and that, like I showed you before, it might go up to 47%. So what you want is a place to distribute, but you still want to distribute it in a way that is tax effective. So, if I give any more money to you, Ray, for instance, you might pay 47%. We don't want to do that. So what we do is we set up a bucket company, or in other terms you might have heard, is corporate beneficiary. And this is where the excess profits the family doesn't need in their personal names, and distribute it to the bucket company.
Say for me, for example, I've got my marketing agency, which is my company, and that does all the trading. Then I have a second company that was set up, the bucket company, and then I have a trust as well.
That's absolutely right. And what we do is essentially any money that you don't need in excess of the business or in excess of your living or your lifestyle, you then distribute to this bucket company. And what's great about the bucket company is you cap your tax rate. If it's a business income that's received, it's still 25%. But if it's passive income, you're still capping at 30%, which is still a lot better than 47. And the best thing about it is you can actually use the bucket company's money to invest as well. So the company that you own and you control can invest in things like shares or property. But obviously there's pros and cons in doing that. And that's where we want to be talking about it further. But there's ways that you can still use that money to advance your wealth and kind of create even more wealth by capping your tax rate.
It's the same amount of money coming in, but it's going through 2 different structures, and one is an efficient one and one is an inefficient one.
If we look at those first 3 strategies, a bulk of our tax savings that we were able to achieve in the last few years was actually just by circling around those strategies itself. And the reason being is every year it's different, and having that proactive advice around those 3 strategies itself has done wonders for a lot of our clients. And I guess when we look at all these other strategies going forward, it might be kind of non-rocket science, pretty straightforward. But this is where you don't want to forget every dollar counts as well. Moving on to kind of like strategy number 4 here, which is to bring forward or prepay expenses itself. Now, this is more relevant for business owners, but for small businesses, what you can actually do is you can actually prepay at least 12 months worth of expenses to kind of claim the tax deduction in this year. Now, there is a limit to that. You can't then go and claim something 3 years worth in 1 year. And simple things that I've seen is like prepayment of rent or subscriptions, prepaying those expenses. And again, I don't ever recommend spending $1 to save 30 cents. This is stuff that you already need to pay. Bringing it forward, especially with years where you might have really big profits or really big income that you want to reduce the tax on. One of the simple, easy avenues that you can take into account as well. Number 5, again, this is for business owners again. And this is where what you don't want is to pay tax on money you haven't received. To put it simply, is you only want to get taxed on the cash that you've already collected from your customers. So very simple example, if you're a builder, at 30th of June, you send an invoice out and it's not paid until the 1st of July. or even 15th or 20th of July. What happens is in the books of your accounting software, usually what happens is it's recorded, the income's already been recorded because you earned that income during that time, although you haven't received the cash. Now, because it's at 30th of June, it was taxable in that year. Now, small businesses and some businesses that have the ability to change this is where businesses would argue that a cash basis business would make more sense. So what you want to do is you only get tax on cash that you've received. So that bill that's sent at 30th of June, technically they haven't received the money yet. But if you don't do this adjustment, this is what accountants can do for you. If you don't change it to a cash basis accounting, you get tax on the unreceived income. And what that means is you prepay the tax in this financial year rather than tax would have paid for the next financial year instead. The next one is you might have heard of this in the kind of recent years, where if you buy an asset, you're able to claim all of it. As long as it's used for business or for business purposes. So small businesses recently well, because of the pandemic especially, the government kind of changed the rules a couple of times on this one. But right now there's a rule called temporary full expensing of assets. So essentially, if you buy an asset for business purposes and you have a revenue of less than $5 billion, and as of today's date, it's still
just under, mate.
Yeah, just under.
And this includes like plant, equipment, and car. This is cars under this as well.
Yes.
Yep.
And there's an asterisk on the car, but there's a lot of assets that you might use. If you're a gardener or if you're a landscaper, you might buy like a lawnmower or anything like that. Those big ones.
Yeah.
They're all immediately tax deductible. Next one, paying employee super. Now, technically, it's not just business owners because you can also pay some super for yourself as well. I'll talk about that in a second. But essentially, for business owners who have employees at 30th of June, what happens is that's the end of your quarter, the last quarter of the financial year. And usually you pay your super for your employees every quarter. So for the last quarter of the year, 30th of June, the super is due on the 28th of July. Now, what you can also do, kind of like prepaying expenses, is bringing forward that payment because you have to pay it statutorily. You have to do it by the 28th anyways. Bring it forward to the 30th of June and you get to claim that deduction in that financial year as well, rather than waiting for next year. Now, on top of this as well, that super could include your own super. If you work for the business and you take out a salary, you can increase that up to the maximum personal contribution limit as well, which is $27,500. And that's what you can do if you're working 9 to 5 as well. If you have a salary, depending on your situation, obviously, this is obviously from just a tax perspective. Any money that you decide to sacrifice into super, it will be future you that get it, obviously, when you're retired. That's what I like about it as well. It's not going to Officeworks. Sorry, Officeworks, but it's not going to any other company or anything like that. It's going to yourself in the future. That's the number one thing I like about it. Second thing is, if you're on a 47% tax bracket, you actually get to tax deduct that, and it goes in, and your super only pays 15% tax on that income. So yeah, massive tax saving. Now, this one, it kind of ties in with the accelerated depreciation. One of the older rules in the past, and this is more for your accountant to check. Now, if you've ever bought assets in the past that was worth more than the limits at the time, like I mentioned, it was $20,000 or $25,000 or even $150. What you had to do was actually pool those assets. For tax reasons, you put in a small business general pool asset. Now, what happens there is you depreciate the whole pool. So you kind of depreciate all your asset at once, at 15% the first year and then 30% the year after that, until it finishes. Now, what you can actually do is write off your small business pool for the 2022 financial year. So if there's any undeducted assets still sitting on your balance sheet as a business owner, you can actually write them off in the 2022 financial year. That's going to save you quite a bit of tax as well. I'm surprised if there is still one, because you could do it last year as well. So yeah, I'll be surprised if you did still have one, but this is something that your accountant should be doing, and you should be checking it to make sure that that's all done correctly as well. Straightforward one, motor vehicle logbook. I've seen time and time again business owners or even employees who use their car for work. What they do
Yeah.
is they claim the car expenses, but they do not use a logbook to track what they're
The worst. I hate logbooks.
there is apps. There is some apps that
There
you
is
can
some
use.
apps. I was just looking
Yeah.
at my phone. I was just like, my client told me an app, right? Maybe it was called Driver's Note.
Yep, that's the one.
Is that it?
Yep.
Yeah, my client said it was really, really easy. Yeah, yeah. Drive. Yeah, if you want to go to, if you're in Australia, just driversnote.com.au. I haven't personally used it, but some of my clients have used it, and they said it was really, really good. And I'm sure there's lots of different options out there. But you pretty much, it's a good idea if you're using a company car or you've got a car to use for work, that you at some 3-month point, some 3-month window, that you use the app to sort of track where you're going and what kind of kilometers you're doing and what all your trips over a 3-month window. So then if the ATO ever comes to you and says, hey, you've been claiming stuff to do with this car, can you please provide evidence of what you're doing, basically, so it all matches up. You already have that ready to go rather than scrambling to like try and either put it together or whatever. Is that right?
Yeah, absolutely.
Yeah.
And then the best thing about it is if there's no significant changes in the way you travel, or changes in how many kilometers you travel, significant ones, that logbook is valid for 5 years. You only have to review it if there's a significant change in your travel patterns.
Yeah.
So it's great because things like fuel, interest, if there's interest on your car,
Yep.
repairs, maintenance, insurance, rego, all that stuff is then
Yeah.
added up, and then,
Yeah.
and then you apply your business use percentage on that. So this logbook will tell you how many percent is business.
Yeah.
You use that all for work as well.
Yeah.
And more often than not, that deduction is a lot more than using the other method, which is just to take
is it cents per kilometer?
Yeah, there's a few cents per kilometer that you can claim, which is, there's a limit to it. Obviously, there's only 5,000 kilometers you can claim. So
Yeah.
that's not much. So if you have a car that's, especially a car that's quite expensive to run, you want to get the most out of it as well from a tax perspective. And you just have to keep that logbook for what, like Ray said, this is that 3-month or
yeah. I actually didn't know that the cents per kilometer. So cents per kilometer is kind of like an easy and quick way without having a logbook, but you can't claim as much because it's kind of like a more of a crude.
Yeah.
Like, or you might not be able to, say if you do, like you say, if you're doing lots of kilometers and, maybe more than 5,000 kilometers and you've got a car as well that, does cost a lot to run, the logbook is the way to go for those people. Most likely, because it's more.
You're missing it.
Yeah,
it can be a couple grand too sometimes.
Yeah, that's interesting. Yeah, I actually didn't. I knew that there was multiple methods. I didn't realize it makes a lot of sense now to do this. So tip number 10.
Yeah, tip number 10. Making sure that if you have a family business that you run and you distribute money to your family, kind of like in the trust strategy, it's not enough that you distribute across your family, but making sure that also when you distribute across, you're not kind of distributing to one person too much and not distributing to the other person. And obviously take that with a grain of salt. If there's legit reasons to do that, then yes. What I mean by this, the crux of it is, if someone was, I'll use Ray for example. Ray, if you go on 120,000 in income already, and you're kind of at that limit of tax that you're paying before it gets too expensive, all the way up to 47%. And then there's someone else in your family group that's at, let's say, 30, 40 grand income, just started working and feel somewhere. What you want to be doing is actually evening it out, the income between the two. So instead of distributing to Ray all the way up, you want to be evening some of the income out to the other family members.
Yeah.
And the reason why is, what you find is Ray might drop one tax bracket down, and then the other family member might go up one tax bracket up. Now, in that situation, across the board, effectively, you're saving more tax than you did if you did it the other way. So again, not rocket science, but I've seen this done wrong so many times, and it just saves you quite a bit of tax. Looking across your family groups. Again, not rocket science. Repairs and maintenance. Now, a lot of us do repairs and maintenance when we need it. What we usually recommend with our clients is to actually look through, if you have a rental property or if you have a business that has premises or kind of a lease, you want to be looking through what you can deduct in terms of repairs and maintenance as well. So if there's it's been a while and you needed to repair that printer before 30th of June is the time to do it. Don't wait till next year. Do it now. For a rental property, that's the same. If there's anything that was broken and that was requested and they've been putting it off, recommend looking at it. Now, it obviously does two things because you need to do it anyways. And remember, not spending $1 to save 30 cents. You need to do it and do it now. And it's just a good activity to do every year to keep your
you should almost have like a I'm almost thinking to have a calendar invite, like whether it's in, I don't know, May or something like that, to be like just double check all the properties and just make sure of like any little bits and bobs, because some stuff, like whether you fix it now or in 6 months, like it's good, like it has to, it will have to get done. And it may not be like an urgent, there's leaky taps or I don't know, there's been a burst water main or something like that priority. But that's definitely something to, you give me an idea.
And there's kind of like other benefits to that as well, right? Like if you're tenants, they'll appreciate that as well.
For
might
sure.
be some retention of tenants effect on that as well. And there is a distinction between repairs and kind of improvement. And generally speaking, if you're repairing something, it shouldn't improve that asset or the overall asset. If the wall, for instance, had a bit of stain on it, it was white painted white again, cool, shouldn't be an issue. That's a repair or maintenance. However, if the wall had a bit of stain and you put
now it's gold plated, gold plated wallpaper
on it, and you go, oh wow, and that's the same with floors, it's all the stuff. So it gets a little bit kind of gray after a while. You're like, oh, what's a repair? What's a maintenance?
Because you probably have sometimes where like floorboards are maybe old or worn down or whatever, and you're obviously you probably won't replace them with the same style. You might be like, they need to be updated, the style anyway, but it would need to be replaced. Like they're due to be actually physically replaced. Exactly. That's an interesting one.
And I guess the thing to look at is maybe the reason why repairs and maintenance is different from improvement is a repair or maintenance cost is usually tax deductible immediately because it's repair costs. Whereas an improvement, if it's on a property, it's usually depreciated over time. And you can claim 2.5% of the cost each year only. So the reason for that is because you've improved the capital base of the asset itself. Like building a pool has increased value. But it's increased value of the property or anything like that. So you technically shouldn't be claiming on it now, but you claim it on it when you sell the property later down the track, the cost on it. So that's the distinction between those two. So now, Ray, you won't have this problem unless that guy in Brisbane doesn't pay.
I want to go hunt him down. I need to. I just feel like it's the principle. It's the principle of it. You know what I mean? But anyways, it's not a counseling session.
That's it. You want to be reviewing your debtors each year. I've seen business owners where they carry a lot of debtors on their balance sheet, and I go, wow, that's a lot of money you're going to collect. And they go, oh, well, this person's not going to pay us. What you want to do is, if you realize that they are not going to pay, they're sitting on the book still, write them off. You can claim that as a tax deduction instead. Because if in the past that would have been included as income, especially if we didn't do the debt adjustment that I mentioned before. If it's included as income, write it off, be done with it, move forward. Yes, obviously assess. Depends on how much it is. Depends on whether it's recoverable or not. And the other thing you want to see as well, what's the cost of you time, energy, emotionally?
Big time. Bonus tip number 13, lucky number 13.
With the last one here is the bonus tip. Now, this covers everyone who invests in property. Something that we commonly see is rental properties that are fairly new, or they have fairly new improvements made to them, and they haven't claimed any depreciation or capital works on the building itself. Now, there's
wouldn't most people get, as soon as you get the property, you would get a depreciation report?
And that's usually the case because they're tax saving usually, and again, depending on your situation and your income that you make in the property. But more often than not, the tax savings that you get out of it outweighs the cost itself in getting the report. The report can range between $500 to $800, depending on how big the property and who you go with. And essentially what it does is it claims the depreciation on the building itself year on year.
Mm.
So what happens is you you might make a profit out of the property from renting the property and paying rates, electricity, or whatever
Yeah.
you pay for, water and all that, and you still make cash profit. So usually what happens is you get taxed on that profit. Now, if you're earning already 120K plus, you're going to be taxed quite a bit on that. Now, if you have a depreciation report and it claims that depreciation, it's not a cash expense, but rather it's a depreciation of the building. So what happens is you might get a cash positive property where you can claim the depreciation and not pay tax on that, because the depreciation causes the property to go into a tax loss, not a cash loss, a tax loss. So that's a win-win scenario. You still get the cash, right? But you also get tax loss. And the good thing about that is this is where you might be able to claim some of that against your any wages or income in your personal name as well, further reducing the profit. Oh, sorry, the tax on your name.
Yeah,
So,
and it's also and you're also obviously getting the benefits of hopefully of capital growth and stuff. So you sort of your wealth is growing, but your tax, how much tax you're paying isn't sort of growing as much with it, basically.
it's kind of like doing a few things at the same time. If your capital grows,
Yeah,
your wealth grows because of the profit or rental return coming in. Your tax on that
then you're offsetting
goes
it.
down as well.
Yeah, yeah.
It does help. Now,
And it's all so many little pieces that you're sort of bringing all together to, because obviously people work, I kind of feel like everyone works really, really hard to bring in whatever money they can. That's like, that's a big chunk of the equation, but it's also like, all right, what happens to the money once it comes in? The structures, the deductions, the whatever it is, the any kind of stuff you can claim or whatever. All of that done properly. That's why like people are, they're getting tens of thousands, hundreds of $1,000s difference at the end of every year that then compounds again. It's
that's right.
Yeah.
That's right. And I feel, I'm going to add another bonus tip in here as well.
14th tip, Jesus! Don't invoice me for this.
No.
The 14th tip.
I feel like I need to throw a little bit for those people who are earning 9 to 5 income, and like, you didn't give me that many tips. One of them is especially if you're a sole breadwinner in your family, or you're the high income earner in your family, and everything is kind of on your shoulders to earn that income. This strategy just makes sense. I don't even have a slide for this, but what I recommend looking into, again, not an insurance broker. You need to go talk to someone about this, whether this is suitable for you. But look at income protection insurance. Now, income protection insurance is something that you can actually get to protect the income that you earn from either your salary job or even the salary from your business that you get. And especially if you're the sole breadwinner, there's reasons for that. If you didn't work, you want to make sure that there's some sort of protection where there's some cash flow still coming through as if you were injured or anything like that, that's still coming through for you. The good thing about it is income protection insurance is usually tax deductible because the income you receive from the insurance is taxable as well. So the ATO allows that you deduct that. Now, you might never claim it, enough, but you get to sleep well at night knowing that your family's protected. And then you get to claim that.
It's a small fee. Yeah, it's actually funny you say that. I was actually thinking about that even yesterday or the day before about that, because the last time I reviewed my income protection, I think it's income protection, but I've got some stuff within super, like TPD and certain insurance and stuff like that. But it definitely because we've been, as you know, we've been like buying properties and stuff, and like my wife works, but she might not work temporarily, whether if we have another kid or all that sort of stuff. And I was just like, if I got hit by a bus or something like that, I was just like, I would be able to pay for stuff with the money that I've already made. But it kind of does. I was thinking about it, I was like, it also would make sense to pay, because you usually don't pay. It depends how much cover you want, obviously, but you might pay a certain amount or a nominal amount. But at least it gives you like, no matter what, you'll get, a base of 100 grand a year for a certain period or whatever it is. So if it all hits the fan, at least it's like, it's not a disaster, or you don't drain all your own assets while you're, recovering or whatever happens.
Correct. That's right. And and sometimes what we don't realize is that we're super important in terms of kind of keeping everything flowing until it all stops. You'll see how all the gears kind of freeze up. And yeah, income protection insurance is designed to kind of keep that moving along, and that's the last thing you want, right? Like when something bad must have happened for you to be on. So yeah, just another bonus tip for today.
No,
Yeah.
I love it. I love it. Awesome, mate. Well, I don't want to take too much more of your time. I really appreciate it. Guys, if you have any questions, obviously you can leave them in the comments, depending on whether you see this on Facebook or YouTube or Instagram or whatever. If you want to reach out to them and have a chat with them, they're kind of, they're not like high pressure salespeople or anything like that. They're pretty chill. They'll tell you basically, they'll probably give you a bit of a guidance around, some initial thoughts around how you could save tax and that sort of stuff. And you can tell them about your situation and all that sort of jazz. Like I said, I don't give a shit if you sign up with them or not, or you just want to have a chat with them and get a second opinion. I don't get anything out of it, but this is who I use, and I've been happy with them for the last few years and stuff. And I really believe in getting great people. Whether it's like I've got a great lawyer, I've got a great accountant. Like I have, you need to have the right people in that seat for your own finances and your own personal situation. I'm a real big believer in that, because stuff just pops up, and as you get older, your situation usually gets more complicated and there's more moving parts. So having the right person makes more difference as time goes on. But if you want to have a chat with them, have a chat with them. If you have any questions, feel free to leave it in the comments. If you've got any like really complicated questions, it's probably better just to reach out to them, and you can have a chat with them about their thoughts around that. And obviously, just disclaimer again, this is just general general commentary and all that sort of stuff. It's not tailored to your situation. So if you want tailored advice, you can chat to them or chat to a professional. And if you want to connect with them, I'll link to their website and their social stuff. And that's pretty much it. Thanks so much, Riz. I really appreciate your time, mate.
Yeah, thanks for having me. And that was really enjoyable. Thanks for having me on your channel.